Thanks for being here. It's a pleasure for us to come down here. We're probably the only two people who arrived last night and said, wow, it's not too humid down here, coming from DC. But glad to be here to talk about what's going on in the economy and in the world of taxes. It's been 8 months since the Tax Cut and Jobs Act was enacted into law. Since the start of the new year, we've been living under this new tax regime. There were a lot of promises made when this bill was passed, a lot of hype. Some of the hype was how this new tax code would unleash the economy and lift up all the boats with that proverbial rising tide. And on the other side, there was a lot of hype that this bill would be absolutely devastating, particularly to the real estate sector. So one of the things we want to do in this session is take a look at that hype and see if it actually has panned out in these last 8 months. So we're going to look at the major tax changes and also take a look through Rob's presentation at what's happening in the economy broadly. One of the challenges, though, to separate out the effects of the tax code from some of the things that are happening in the economy is that there is so much affecting the industry. We have lumber prices, rising interest rates, regulatory burdens, labor shortages, lack of inventory, lot shortages, you name it. Those are all coming into play. So it's one of the reasons why we wanted to do this as a combined presentation so we can give a much broader look beyond the tax code, and hopefully you guys find that to be interesting. What we're going to do is we're going to break this into 4 different segments, and then we'll stop and do a couple questions after each one. So we're going to start with a look at the single-family sector, then remodelers, multifamily, and then we're going to finish with some of the general business provisions and what's happening broadly in the economy. We'll mention a little bit about some of the regulations that came out yesterday from the IRS that are very important in this tax discussion. So I'm not going to get much into the politics of tax reform. I've done a couple presentations down here in Texas, so some of you may have heard my speech on that front. But I do want to talk just briefly. The last time we did tax reform was in 1986. And if you were in business in 1986, or if you've heard the stories, you know that that tax reform bill was absolutely devastating to this industry. Particularly if you were in commercial or multifamily real estate. A lot of folks ended up in bankruptcy. So we started this task of tax reform with a fairly simple goal, which is don't repeat 1986. It sounds simple, but actually making it happen wasn't so simple. And part of the reason is I think we go through this, you'll see that I think we were very successful at not repeating 1986, is the leadership and the membership we had from the association. And the fact is that whether from the local, state, and federal levels, we all came together and worked and supported each other, and that's the reason we were successful. And leadership from folks like Granger McDonald, who steered us as chairman of NAHB for last year through this tax reform effort, was absolutely essential. All of you were extremely helpful in making this possible. I think it's fair to say that if we hadn't engaged in tax reform, if we had taken the position of 1986 and just opposed everything, we would be having a much different conversation than the one we're going to have today. I am very confident that this tax bill is better, a whole lot better, because of our efforts, because of our engagements. And I hope that when you're doing your taxes next year, you all end up seeing the benefits of what we were able to do with our advocacy last year. And ultimately, we're dealing with a $1.2 trillion tax cut. So there is a tremendous amount of money flowing back into the economy, and hopefully that is good for us in the next couple of years. Before I get into the details, I want to mention what I call the lurking time bomb in our new tax code. Due to some of the procedural maneuvers done, many provisions will expire after 2026, or actually starting January 1st, 2026. All of the individual changes expire. So this is extremely important as you're thinking long-term, is know that there is no certainty in the tax code. To be honest, there's never any certainty in the tax code, but here we have a built-in fiscal cliff ahead of us. In addition to all the stuff that is permanent, the lower corporate rate, all of that stuff, it's inevitably going to be renegotiated as they figure out how they're going to handle this deadline. And it's important for me to mention that between now and 2026, there will be 4 congressional elections and 2 presidential elections. So we have no idea who's going to be in control of what when this is actually sorted out. So just something to keep in mind as you're thinking long term. Now, as we dive into the single family changes, obviously one of the most visible fights we had is the mortgage interest deduction. And really as we went into this, the House came gunning for the mortgage interest deduction. The initial proposal that they put out would have lowered the amount of debt that's eligible for deduction from $1 million to $500,000. They would have eliminated the deduction for second homes, and they also eliminated the separate deduction for home equity lines of credits, HELOCs. Now, one thing to mention on the second home issue is that's important not just for markets where second homes is a substantial portion of the market share, and obviously home values are very tied to that market, but also as a quirk in the tax code, anyone who moves ends up being a second homeowner. Because the way the tax code works is it says you own a house, you sell it, and you buy a new house in the same year. You own 2 houses at some point in that same year. One of them is a second home. So if they'd eliminated the second home deduction, it would have caused all of these unintended consequences for people moving. You would start to see your buyers be like, well, I want to buy, but I'll wait till the end of the year because I want to maximize my deduction and all this other nonsense. So for us, saving the second home deduction is more than just the importance of those markets that have a lot of traditional second homes. So at the end of the day, we fought back, we pushed back against the House proposal. So the new law starting January 1st is we have a lower, but not as low as proposed by the House, cap on acquisition debt, $750,000. Important to remember, if you have a mortgage higher than that, you still get the mortgage interest deduction. You just don't deduct the interest on the debt above $750,000. So that affects about 630,000 mortgages around the country. So it shouldn't have a sizable effect as would have been the case if it were lowered to $500,000. We're able to retain the deduction for second homes. The only thing that we fell a little short on is the separate deduction for HELOCs. But when we get to the remodeler section, I have very good news for you. We were able to do some good there, so we're going to talk more about the HELOC issue in the next section. So we'll hold on for that. And then one of the other big changes, perhaps the biggest change since the beginning of the year in terms of press coverage, is the state and local tax deduction. This is your ability to deduct your property taxes plus either your choice of state income or state sales taxes. Obviously, that's an easy choice in Texas. And what happened is the original idea was to eliminate this altogether. It's actually been on the to-do list for certain folks since the 1986 tax reform effort. And they came really close to eliminating the SALT deduction. But regional politics came into play, and particularly Republicans from the Northeast pushed back. And we kind of jumped in on that because this is a really important deduction in real estate because of the property tax deduction. So as part of our fight there, what we were able to do is take it from a full repeal to no repeal, but a new limitation. We can only deduct $10,000 of your combined state and local tax deduction. So that's a much better place from where we started from. Now, in Texas, just to give you an idea, about 23% of taxpayers have historically itemized. So you actually have a fairly small number of itemizers. and their average SALT deduction was $7,800. So most of your consumers, most of you, shouldn't be affected by this new $10,000 cap. But what if you are? There is some good news in this. If you are affected by this limitation, or if you are building and selling in the higher end marketplace where folks might be paying significantly higher property taxes. And that connection is with the alternative minimum tax, which is a sort of odd thing to bring up. But what most people don't realize, because if you're paying the AMT, you're not calculating it yourself. Either TurboTax is doing it on the computer or your tax preparer is doing it for you. But when that calculation occurs, one of the things that you lose is your state and local tax deduction. You don't lose some of it, it completely eliminated it. So anyone who's paid the AMT was already completely eliminated with their state and local tax deduction. So in the new tax code, one of the changes made dramatically alters the number of taxpayers who will be paying the AMT moving forward. It's going to be 95% fewer taxpayers. It's a fairly substantial and positive change. It's going to drop from 5.4 million AMT taxpayers to about 200,000. And I know a lot of you, particularly if you're the business owner, you ended up paying AMT as well, because it's very common as a pass-through business owner to end up being stuck in the AMT. So hopefully this change also is very positive on the AMT front. So I wish they had just completely eliminated the AMT. It kind of drives me nuts that they kept it. But I think this is a really positive change and one that we should not overlook. And then one of the other fights we had is on the capital gains exclusion. You know this is the provision where you live in your primary residence for long enough, and when you sell it, you don't have to pay taxes on the money you make. Right, so the rules were, if you live in the house of your primary residence for 2 of the last 5 years, you didn't pay capital gains taxes on $250,000 as a single, or $500,000 if you're a married couple. So what was initially proposed here in the House was to take that 2 of 5 year requirement and move it out to 5 of the last 8 years. And in addition, they decided it would be a really good idea to completely eliminate this benefit for higher income taxpayers. Now, as we're looking at this, and particularly Rob and I talk a lot, we're looking at one of the softer areas, the marketplace, that first-time buyer marketplace. Can you imagine you're a first-time buyer and you're trying to move up the housing ladder, and now all of a sudden you have to own that house for at least 5 years and be committed to that 5-year period before you can cash out and take your capital gains and move up? It's really going to add just another mental barrier more than anything had they enacted that provision. And then, in my opinion, the stupidity of having an income phase out. You have no idea how much money you're going to be making when you sell your home. It just adds unnecessary complexity. This is the one area we pushed back very hard, and I'm really proud to say that we completely flat out won. They didn't change this at all. So in fact, it was a $22 billion savings that we achieved for home buyers by keeping this provision exactly as it always has been. And I think that's really important for the industry as we move forward.
All right, so the way that we're doing this presentation, this is actually the first time we've tried it this way, but we're going to do a little bit of tax, then a little bit of econ. If you find one or both of them boring, hopefully at least the transition from topic to topic will keep your attention. JP is going to describe, as you just did for the single family side, what changed in the tax law. So I'm going to give you kind of a sense of where the market is and kind of how the interaction of the new tax law and the overall economic situation. So this is our national forecast for single-family construction. You can see there in 2018, we think probably going to start about 900,000, a little more than 900,000 single-family homes. That is about a 9% growth rate over 2017. So overall, we think the tax reform bill is a positive thing. Some of the changes that JP said in terms of protecting some of those existing items, higher standard deduction, which means prospective first-time home buyers will be able to save their down payment a little bit faster. But we've got declining growth rates going into 2020, and I'm going to talk about that in a little more detail in when we go through some of the business items. But generally speaking, we think the economy is going to be softening going into 2019, 2020. But here's the number to really kind of pay attention on this. You can see the single-family starts forecast. We're underbuilding. So basically, by the end of 2020, we're still not even at 80% of what we think is roughly normal levels of production nationwide. Normal levels of production would be kind of about 1.2 million single-family starts a year. So notice in 2020, my start forecast is still only 1 million. And you get that 1.2 million, by the way, it's about 900,000 for population growth and about 300,000 to replace older homes. So the fact that we're only at 80% or so means that we continue to underbuild. So we think that demand is there. The tax reform bill, by putting more money in people's pockets, is going to help keep up rental demand and for sale demand, and we're generally seeing growth going forward. It's worth noting, home builder confidence is really positive right now. This is the NAHB Wells Fargo HMI. It's our monthly builder confidence measure. It's currently at a level of 68. It's probably worth pointing out it peaked at a level of 74 right after the presidential election. We said that due to Granger's year at the top of the home building industry, but builder confidence took a step up after the elections on the hopes of what we saw: tax cuts, deregulation. The only downside is some of the trade policy issues that were mentioned going forward. The big issue, though, between kind of where the HMI and housing starts used to track and what we see now is builder confidence is really high, but production remains modest. And we'll go through some of the reasons for that. Looking at this state by state, the way you read this, states in red are growing in a negative way. They're actually declining for the first 5 months of the year compared to the first 5 months of 2017. States in yellow, they're growing compared to the first 5 months of 17, but they're moving a little bit slower than the national average. And then the states in green for the first 5 months are actually growing faster than average. Texas, it's right kind of near the cutoff point. I kind of think of this as more yellow-green. But a lot of the growth and heat and hot housing markets really in the mountain states right now. California is still kind of playing catch-up, and of course the southeast, places like Florida, really kind of the growth centers for single-family construction. This graph's a little hard to read, so I'm going to try to expect you to absorb it here at one. But basically, we've got the state postal codes. These red bars are where we are right now. The blue bars are kind of relative to normal, which here we're defining as the 2000 to 2003 average. But the blue bars are where the states were at their minimum point during the Great Recession, so you can kind of see as they decline. And basically, those states that have the top red bars are the ones that have a lot of growth right now. So it's not surprising to see Montana, Utah, Idaho, and Texas is right here. I think it's ranked 7th in terms of where it is now compared to where it was on average 2000, 2003. So, the big hot states recently have been those Idaho, Montana, Utah, Colorado. And in part, those markets have been driven up because those West Coast markets, Seattle, Portland, California, chasing their young people away by over-regulating those markets. It made land really expensive, made it hard to develop apartments and single-family homes, and the result is those mountain states are doing really well. But again, Texas kind of ranks 7th according to this measure. And then I just want to mention a couple little sub-markets before I hand it back to JP for some of the remodeling elements. One, the custom building market right now is about 20% of single-family construction. It's growing nationwide at about a 2 to 3% growth rate, so a little bit slower. We are seeing some saturation up at the luxury end in a lot of markets, some price growth slowing, particularly in the West, in the high-end markets, and that is kind of reflecting some of the growth trends in custom home building. The townhouse market, this is one of the hotter markets. It's currently only about 12% of single-family starts. But as we see the demand growing, where the demographics are causing those millennials to move from renting to owning, I think this market kind of checks all the boxes as a bridge between rentership and homeownership, particularly in high-cost areas where it's hard to get land. We build more units in a given amount of dirt, and my expectation is the market share for townhouse construction is going to rise 15%, be growing 8 to 10% year over year over the next few years. Right. Yeah, so this is a good point to pause. If you had any questions on the single-family rules, or any of the economics? Questions? All right, we'll keep going to
We rarely have such clarity. Must be post-lunch food comas going on. Can't be the topic, putting people to sleep. This is exciting. So let's talk a little bit about what's happening in the remodeler side. I mentioned home equity lines of credit. So there was a separate provision in there for a $100,000 HELOC deduction that unfortunately was eliminated. We fought really, really hard to preserve that. And what we found out was happening is there was an impression, and frankly not an incorrect perception on the Hill, that HELOCs were often used for the wrong purposes, and that by allowing them to be deducted, the tax code was encouraging homeowners to take money out of their home and use it for things like vacations, or you could technically take that money and go to Las Vegas and put it all in black and deduct the interest on it. So there was this notion that that wasn't a positive thing, using your home as an ATM. And in fact, we said, all right, we understand that. That makes sense to us. How about we limit the HELOC deduction to just using that money to reinvest in your home? Frankly, what happened was they did this so fast, really 7 weeks from start to finish, which is unheard of, that they didn't have time. They just basically said, we don't have time to slow this down and make that fix. So unfortunately, that separate deduction was ultimately eliminated. But the very first thing we did at the staff level is say, all right, there's got to be a solution for the remodelers in here. We got to make this work because this is such an important source of financing for homeowners looking to renovate their home. So we dug into the rules of the mortgage interest deduction. We found a hook. And we realized that the rules should allow people to continue to take out a loan and use it to finance home improvements, including a HELOC. So we wrote to the IRS and we pulled a bunch of strings, and the IRS updated back in late February or early March their guidance for the mortgage interest deduction and said, yes, under the mortgage interest deduction, under that $750,000 cap of debt, you can take out a loan, including a HELOC, and deduct the interest as long as that money is used to substantially improve your home. So that's the key. And this is a really substantial and very quick and early win for us. I can't tell you how many other tax lobbyists called me and said, how did you do that? Actually, I'm still not sure how we did that, other than we had a very convincing case, and they actually used our language. So the big question is what's a substantial improvement? This is not my words. These are the actual IRS words. This is how the IRS defines it, and you'll see that it's very broad, which is very good. So pretty much most remodeling activity should qualify in one of these three categories, and that is an or. So you don't have to meet all three, just any of it. Add value, prolong your home's life, adapt the home to new uses. If you're not doing that as part of a remodeling project, I would be very surprised. The only thing explicitly prohibited as a substantial improvement is using it solely to repair the home. You can do repairs as part of the remodeling project, but you can't just take it out, replace your HVAC system, and that's the end of it. That actually wouldn't count. So we were very happy with this particular fix. I think it worked really well for the remodelers. We haven't seen any problems with this to date. Rob,
Yeah, so on the remodeling market, we've got actually pretty strong growth rates. I keep telling people that the remodeling market is the one market that we haven't done a particularly good job of forecasting over the last few years. 2017 is a good example. The market actually expanded nationwide 19%. Pretty obvious why this is happening. Home prices are going up, people are moving less, they have more wealth, and therefore they have more demand to basically either age in place or make changes to their homes because they're not moving. The problem is our model kind of looks at the fact that people are moving less and assumes, oh, okay, we've got fewer existing home sales, so there's less remodeling associated with buying and selling a home. We're in the process of revising these numbers up, but basically our forecast right now is pretty strong, and my expectation is by the time we get our revisions done, we'll be looking at above 10% growth rates in the remodeling market going forward. And the big thing that's kind of driving this behind the scenes is the fact that the housing stock itself is aging. Typical homes about 40 years old right now. And you can look between 2005 and 2015, the share of homes that are 45 years or older has been expanding. This should keep growth in the remodeling sector going forward for the next decade or so.
Any questions on the remodeling space? I should mention that Rob is remodeling his house right now, so he should know very well how the market is. Any questions? All right, let's get in a little bit into the multifamily space now, where it gets a little bit dense. I try to keep this stuff interesting, but my topic is the tax code, so I'm somewhat limited by the sheer nature of that. But one of the things that was very important in the tax fight related to multifamily is the depreciation timetable. You can actually go back to when the Republicans started this push. They wanted to increase multifamily depreciation out to 40 years, which would have done exactly what our mission was to avoid 1986. It would have happened all over again by significantly devaluing all those assets. We actually banded together with all of the real estate groups and did some really groundbreaking research on what the appropriate depreciation period is for multifamily. It's actually a little less than this. And that, at the end of the day, combined with some other efforts, won the day. So the new law keeps the old depreciation period, 27.5 years, or extends it slightly. There is a slight asterisk, and we'll talk about this when we get to the general business discussion. If you elect, depending on how you elect to treat your business interest deduction, the depreciation period might go to 30 years. And again, I'll get more into the details of that in the next section. And then some of the other major multifamily battles we took on, like-kind exchanges. This was a really interesting fight because my notion of what a like-kind exchange was, a 1031, is a real estate transaction. What I didn't realize as I went into it is how many other different industries were using 1031s. You had literally high-end wine collectors swapping bottles under a 1031, art collectors swapping collections, baseball collectors, but also, which surprised both of us, apparently every single car rental company was using 1031s. So we're sitting around thinking, hey, all these other groups are using it and it doesn't exactly look good on the tax provision. How do we get away from it? So this is another case where we worked with other folks in the real estate sector and basically made the case for why this is important for real estate. We let everyone else make their own cases. Well, what's the new law for like-kind exchanges? They were eliminated, except for real estate. So I think we made our case pretty well. That is a very important provision to preserve that. Carried interest is another big component to multifamily deals in a lot of cases. If you followed this debate at all, it's been going on for 10 years to abolish carried interest, not because of how real estate uses it, but because of how some Wall Street investment fund managers have used carried interest. So we've worked very hard to try to separate ourselves from that, and I think we were fairly successful here. So what did they do with carried interest? If you use a promote in some of your deals, it's preserved, but there's now a requirement to hold the asset for 3 years. And that is to basically create a barrier between a longer term investment versus what was happening on Wall Street, because those Wall Street fund managers aren't holding those investments for 3 years. So it might require a slight reworking of some real estate deals, but I think by and large that 3-year holding period will work, and it's certainly a lot better than not having an option whatsoever. And then one of the other major fights we had involves affordable housing production. Even if you're not involved in multifamily affordable housing production, you should care about this provision. Because my guess is back and wherever you are building in your marketplace, you're feeling pressures from things like inclusionary zoning and producing some sort of affordability. Well, this is actually a program that flat out pays from the federal government for the construction of affordable housing, so the burden is not placed on the typical builder. It's very important. It's really the sole source of affordable multifamily rental production out there. So it was on the chopping block. We worked very hard over a number of years to preserve the low-income housing tax credit, and I'm proud of the work we did there. And I think for those of you engaged in this, we're also hopefully going to have some opportunities to do some more on affordable production towards the end of the year. But it is something I do encourage everyone to pay attention to, even if it's not your field. It does help sort of lessen that stress that you get from the policy standpoint of we need more affordability. This is one of the tools we have that works really, really well.
All right, so turning to the multifamily market, I put this slide up just to give you a sense of the single-family, multifamily balance in the industry right now. This black line is the multifamily share of units under production. Red's in multifamily, single families in blue. Basically, since 2013, more than 50% of the units under construction at any given moment have been multifamily apartments. So this has been a multifamily-led recovery. I think we all kind of know that. But notice that the share is beginning to tick down as single-family construction increases, and I give you my forecast for that. We do think those trends will continue. And here's our multifamily forecast going forward. We think that 2015 is likely the peak year of multifamily starts, although in 2018, you kind of see it right here, we had this little spike of production at the start of the year. But generally speaking, our forecast is one of leveling off. I think we're headed back to about 330,000 starts a year as we kind of get through this initial surge at the beginning of the year. But basically not a hard landing for multifamily, kind of a soft landing, returning basically to demographics after the run-up early on when it was multifamily production that was really leading the housing sector. In terms of the components of multifamily production, the red line is the built for rent share. And for historically, it's been about 80% built for rent, so 20% condo. I think what's worth noticing here, right now, it's pretty much an entirely built for rent market. In fact, the most recent data, it's 95% built for rent. Condo production has not been part of that story. That's kind of a missing market that really never rebounded after the Great Recession. There were some rules changes that occurred with FHA financing, some legal liability issues, and we don't think that's going to change anytime soon. Since we're talking about rental housing, I thought I'd put this up here because it always comes up in Q&A. How about the single-family built for rent market? Well, you know, right now it's kind of a little higher than 4%. Historically, the single-family built for rent market on the single-family side is typically about 2.8% of single-family construction. So the fact that it's at 4.4 means it's elevated. And I think this sub-market tends to get a little more hype, particularly in the press, than it deserves. There's certainly a lot of mom and pop owners who are moving and not selling their house and choosing to rent it out. That's occurring. That's in the millions. But in terms of actual new construction, single-family built for rent remains fairly small. What has changed? Take a look at the columns in blue here. This is multifamily production by property size, so 2 to 4 units, 5 to 9, 10 to 49, and then 50 plus. Look at where 50 plus production was in 1999, just a little more than 10% of total multifamily production, and then look at where it is today. It's 50%. So there's been a really massive shift on the multifamily side towards larger units. Some of this is due to the fact that a lot of the production in the last few years has been concentrated in the top 15 markets. I mean, we've seen some slowdown, obviously, in markets like Houston and Dallas, but you do have a lot of this being concentrated in the urban core, larger properties. All right, so that's probably a good time to pause for questions on multifamily or those other issues. All right, you guys are going to have to come up with some questions after the business section. But I think the way we're going to do the next part, and I'm telling this to JP, he's going to run through the business side. We'll pause after his presentation because this will be a little more dense. And then we'll pause for tax questions. And and then with whatever time we have remaining, I'll go through my macroeconomic forecast, and we can do Q&A at the very end.
I think that's a good move. When we look at the new tax law, it's ironic. One of the challenges, one of the goals stated was to simplify the tax code. If when I'm done with this presentation in this section, you think the tax code is simpler, I have a bridge to sell you, because this is going to get pretty complicated. But this is the most important set of changes that we have in the new tax law. This is what affects you as businesses. So understanding how you can maximize this is going to really potentially make the difference of who's going to be able to jump out and take advantage of, I think, some real opportunities for some significant tax savings. And it might require you to think about things a little bit differently, to potentially even structure your deals and partnership agreements a little bit differently. But there's a lot of money to be saved here. So hopefully I can highlight some of these savings. Now, one of the challenges, at least for us presenting this, is yesterday morning, the IRS gave us a little present, 181-page present, which is the long-awaited draft regulations for this new 20% pass-through deduction that I will talk about. The only upside is Rob and I are traveling together, so we were able to sit down and somewhat go through this, and our colleague back in the office also read through this. So I'll give you a little bit of a first blush with the caveat that it's a very early read. In general, I think our first blush is that the new regulations are going to be pretty good. I think they did a good job in terms of keeping it an open deduction. So we'll talk a little bit more about what some of those new regulations are. But the biggest thing, particularly with this section, that I really have to emphasize is you need to talk to your CPA. We can't give you specific tax advice. We can give you overarching things that you need to make sure you're going to your CPA and talking about. And maybe a little bit we can make sure that your CPA is focused on the right stuff. And if you're not hearing your CPA talk about some of this stuff, you might want to shop around a bit. So let's start with the business interest deduction. Big fight we had over this. This is really important for just the overall forward progress of the industry. There was this perception up on Capitol Hill that you guys could go to Wall Street with a big bag, open it up and say, I want to build a couple houses here, fill up my bag, I need money. Seriously. And so they were going to eliminate the business interest deduction for everyone, because the thought is we actually incentivize, what they were saying, people to take on debt when they could go to Wall Street and get equity financing. And I'm like, what world do you live in? A typical builder goes to the community bank, begs for financing, and if they're lucky, comes away with what they need at a reasonable interest rate and moves forward with the project. If you eliminate their ability to deduct that interest, you raise the cost of doing business. That's bad for the industry. We showed them exactly, thanks to work from Rob's team, how much that cost would go up. They said, holy bleep. And we were able to be one of two industries to receive a complete carve-out from the new limitations on business interest deduction. So the limitation now is you can deduct 30% of your income, broadly said, can be business interest deduction. If you're in real estate, you can continue to deduct all your business interest, even if it exceeds that. But there are some trade-offs. So if you remember back to that multifamily depreciation period slide, one of the trade-offs is if you elect to deduct all your business interest, your depreciation period goes from 27.5 years to 30 years. It also affects your ability to do some of the new expensing provisions. But if this is a major factor in your business, having this option is very important. We're glad to preserve it. And it's something to talk to your CPA about how the different trade-offs affect your business. And now the much mentioned new 20% pass-through deduction. Most of you are likely pass-through owners. That is typical of the industry. And this deduction is sort of the counterpart to the fact that C Corp's got a big rate reduction. This is what the pass-throughs got. And it is super complicated. There's actually 3 calculations involved here to figure out how this deduction affects your business. Which calculation you use is going to vary on a couple different factors. The first factor is income. If your income is below $315,000 as a couple or $157,500 as an individual, you're going to use this first calculation, and you're lucky. And this is what the bulk of home builders will end up using. This is where they will fit, as well as the subcontractors and everyone else in the industry. This is the simplest calculation. It doesn't have a lot of restrictions upon it. And it's based on your, what they call qualified business income. Qualified business income, we'll talk a little bit about how that works in a second. But in total, this deduction is $415 billion in tax savings. That's a ton of money. Go out and get it. It's there for the taking. So let me give an example in the first calculation. So this is, we call this the income exemption method. And again, this is if your income is below those thresholds, $315,000 as a couple. And it is based on adjusted gross income. So what you actually pay taxes on. And the way it works is you take the lesser of 20% of your taxable income, or what they call 20% of your qualified business income, which is your income minus capital gains and minus reasonable compensation. You do have to pay yourself unless you're a sole proprietorship, and that, with whatever you pay yourself, is not eligible for this deduction. So put in sort of a very simplistic example, and you can see how this works. So for simplicity, I'm using a sole proprietor because they don't have to worry about their salary. They can deduct it all, and they make $100,000. So this would be a subcontractor in a typical scenario, $100,000. They also claim the new $12,000 standard deduction for singles. This is a single person. So I said there's 2 ways you have to calculate this because it's a lesser of calculation. So their taxable income is $88,000. You multiply that by 20%. The deduction is worth $17,600. The other way you do it is you do it on total taxable income. So 20% times 100,000, that would be $20,000, but that's more. So you take the lower amount, $17,600. So that is the new tax savings this individual would get with this new deduction. And when you factor in the fact that they have a $12,000 standard deduction, they're not paying any federal income taxes on almost $30,000 of their $100,000 of income. So this shows you the magnitude, the potential of this new deduction. And it also shows for your subcontractors, they should be feeling a lot better next year when they pay their taxes, because it's a pretty good tax cut. Again, S-Corps, anything, if you're under the income thresholds, this is the calculation you use. It's fairly simple, it's straightforward, there's not a lot of rules to it. That's the one you have to use if you're under the income thresholds. But what if you're not? So, here's where those new regulations that came out yesterday morning come into play. Those regulations deal with the pass-through owner who has income above those thresholds. How do they make this calculation? When Congress came up with this idea, this deduction, one thing they wanted to do was limit it for higher income businesses. They wanted to not give it to certain sectors, such as law firms, doctors, accountants, service providers, if you will. But it wouldn't shock you if I said Congress didn't do the best job of really defining all those different sectors. In fact, they threw in a wild curveball and said, in addition to doctors, accountants, specific things they enumerated, we're also going to put in this thing called skills and reputation. If your business relies on the skills or reputation of one or more employees or owners, you don't qualify for the deduction. And we're looking at that and saying, well, almost every home builder, it's their name on the title of the business. If you're a remodeler, you're hired because of your skill. Are we going to get caught up in that? And we spent a lot of time doing a lot of very boring tax research, sending comments to the IRS early before they were asking for them. And so yesterday morning when we're sitting at the airport, the first thing we search for is skills and reputation, and go right down to whatever that was, page 50 something, and start reading to see what the IRS said. Because this is going to be really make or break for the industry. And I'm extremely pleased you're actually the first group we can say we're saying anything substantive to, that our first examination of the skills and reputation test is they produced such a narrow definition of who's excluded that almost no one is excluded from it. It's fantastic. The folks who are excluded from it are actually by and large excluded from it elsewhere in the code. So some of the exclusions under skill and reputation test include if you're making income from endorsements, licensing your image, appearance fees. I'm not getting paid for this, so not a problem. My endorsement income is extremely low. So basically, if you're a celebrity, a movie star, an athlete, that money doesn't qualify, but guess what? They were already excluded anyway, so not a big deal. So the good news is that doesn't affect our industry based on our first look. Now, it's actually 184 pages in this thing, and there's a lot of stuff in about aggregation. If you have multiple businesses, how you calculate that and add it together. The good news is you can add it together. The bad news is that I can't tell you how this affects your business because you're all structured differently. So you're going to want to take these draft regulations and sit down with your CPA. It's a 45-day comment period. We'll be taking a look. If you have issues that you see in it, let us know, because then NAHB can provide those types of comments too. But what we're generally seeing from a lot of other industry groups and their initial reaction is pretty positive. As well as there's rules if you have a trust as part of your business function. That's allowed, but there's rules in there that you're going to want to take a look at. So I think we feel pretty positive with 36 hours into this process of looking at these. But again, feel free to reach out to us. My guess is Rob has his contact information at the end, so you can email him. So let me talk now a little bit briefly about how this calculation works now that the rules of who qualifies and what income qualifies are out there, at least in draft form. And there's two ways to do it. One is based on W-2 wages, and the second is based on W-2 wages plus depreciable assets. And I'm going to go through this really, really quickly. So the first one is helpful if you have a lot of employees. Essentially, all you do is you take all of your W-2 wages paid, excluding yourself as the business owner, and you multiply that by 50%. And so long as that does not exceed 20% of your taxable income, that is the amount you can deduct. So I use a simple example: $100,000 of W-2 wages, 50%. You have a $50,000 potential deduction to take there. The third option is the most complicated thing you could ever imagine, but if you're involved in multifamily or commercial real estate, or a land developer who has a lot of tangible assets, this is a deduction you want to understand. So this is basically the scenario of I don't have a lot of employees, but I'm involved economically in producing a lot of stuff. So what it does is it takes a lesser amount of W-2 wages, brings into the mix depreciable assets. So the calculation is now uses 25% instead of 50% of W-2 wages, plus 2.5% of, this is my favorite wording in the entire thing, unadjusted basis immediately after acquisition of all qualified property. What the hell does that mean? It's very simple. You buy a building for $100,000. For the entire depreciable life of that building, you get to use $100,000 for calculating this calculation. As soon as the depreciable life of the building is over, it's worth zero. So that's why it says unadjusted basis immediately after. You don't adjust the basis until it's no longer depreciable. Same thing goes for trucks. In fact, the depreciation period is extended to 10 years under this provision. So you have a $20,000 truck, you can deduct $20,000. It doesn't decline. But then once it's out of the depreciation window, it's zero. So it is something important to think about if you're using this calculation, is the age of your assets. Make sure that they are eligible for this. I do anticipate if this sticks around long enough, you're going to see some churn in the commercial multifamily industry as people reset their basis in order to maximize this deduction. So the quick calculation is same business, $100,000 in W-2, but $2 million in qualified property. So you take a 25% of $100,000, $25,000, and then 2.5% of $2 million. That's a $50,000 reduction. So now they get to take off a maximum of $75,000 as the business owner, again, not to exceed 20% of their taxable income. So that's how this provision works in an extreme short explanation. And then lastly on the tax front, talk a little bit about the corporate rate change. One of the most common questions I got from folks is should I switch to a C Corp? The C Corp rate just fell from 35 to 21%. My answer to that is I don't know. You have to figure that out based on the structure of your business. But I do like to point out and remind folks that C Corp income is still subject to double taxation. That 21% rate is at the entity level. All income coming in there is taxed at 21%. If you actually want to put that money into your pocket, which most of us do at some point, you're going to have to pay it out and pay taxes on it. You have a lot of choices. The cheapest way to pay it to yourself is as a dividend, and the rate on dividends is 15 to 23.8%. So you're paying that on top of the 21% corporate rate. So there might be cases where having a corporation makes sense for certain deals where you're not paying yourself something, but I think by and large you will find that the pass-through structure with the new deduction is going to equate to a lower tax rate at the end of the day. But this is ultimately was the entire motivator for tax reform, was to lower that corporate rate. We now have one of the most competitive corporate rates in the world. At 21%, and we will see where that takes us in the next couple of years. So that's actually more your slide. Take any questions you guys have about that. I know that's a ton of information. So the question is the qualified business income deduction, who does it apply to? Any pass-through business is eligible for that deduction. Not your C Corps. The C Corps got their lower corporate tax rate. It's just a pass-through. You can be structured any way as a pass-through. You can take it. It's taken by the individual. So as long the LLC and all those assorted deals, it's all eligible, and it's gonna flow down to the individual owner, and they're gonna be able to take that deduction. And that's what the bulk of those regs that came out yesterday focus on, is when you have that scenario where you have LLCs and different partnerships under them, is how you aggregate those, but it's totally allowable. Jerry? No, $315,000 is, so the question is what happens after you take that deduction on the $315,000? $315,000 actually only dictates how you calculate the deduction. You can take it on an unlimited amount of pass-through income. There's no limitation whatsoever. You can have $1 million of pass-through income. You just use a different method to calculate it, using one of those last two methods.
And the rest is tax.
Yes, and whatever your ordinary marginal tax rate would be. That's correct. So what, in general, the 20% deduction should lower your marginal rate by 5 points. That's sort of a baseline calculation of what it should end up doing in most scenarios. I think there's another question in the back.
Where do you get a list of specialized CPAs? It seems like nobody knows how to do it, right?
Yeah, the question is how do you get a list of CPAs that are specialized in construction? The best advice I can give to you is that in most locals, there is a CPA who's a member, if not multiples. And I would look first at the CPAs who joined our association. They should specialize in dealing with you guys and know this as well as anyone. I also would highly recommend asking probably anyone in this room for who they use. And I think it is smart to make sure you have someone who understands how this affects construction. I have heard some very interesting things over the last couple months that are, let's just say, interesting interpretations, and I wouldn't want to be their client. So that's my advice, is to look at your local or at TAB's membership list and call some CPAs up there and have a conversation with them.
Has there been any rulings that you own multiple pass-throughs as far as the aggregate number of employees, or that you have one pass-through entity that has very few employees, very high income, and other pass-through entities that have very low income that carry most of their salaries? And it's common ownership, the pass-throughs are common ownership. Has there been any ruling on how they're going to do that?
Yeah, so the question relates to where you have multiple entities and different numbers of employees, or even a scenario where you have no employees in an entity. How do you aggregate that? That's exactly the regulations that came out yesterday. What they're trying to deal with is how you would do that. But it is going to be allowed. The first question before those regulations is, can you even aggregate that stuff? And the answer is yes. So that's important. And then how you do it is in that 184-page wonderful read. If you're having trouble sleeping. So the good news is as of yesterday, they're out for comment. Take a look at them and see if they pose any problems for how you're structured. But you should be able to do that, and it's going to be partnership interests and how you sort of allocate all that different stuff. That's what the rules are trying to spell out. If they fail to do that, that's something we would really value input back on.
Okay, so we thought we would just end with the general sort of what do we think the tax reform bill is going to do to the economy, and I think kind of this is a good place to sort of reflect, what we fought against, what we succeeded in winning, because if you think about from an advocacy perspective in terms of the industry, obviously we had to be engaged on the single-family side, the multifamily side, the modeling side, but at the same time, those items were being used as revenue raisers to pay for business tax cuts, which can both help us directly as an industry, but also provide money in people's pockets that will help housing demand. And I think we came out, if you had to kind of score it, it definitely put us in the A minus range, because we ended up with a bill that not only gave us business tax cuts, but protected most of the housing and real estate items. So if we're thinking about in terms of what we think it's going to do to the economy, we've marked up our 2018 forecast to 3%. And I would note that's where the current administration wants to be. They're targeting a 3% growth rate on GDP. And for the first time, we got a dynamic score, which basically means when they cut taxes, what's it going to do to the economy? That was counted this time and gives us some growth effects, some pro-growth tax policy. They've talked about doing that in DC for 30 years. This is the first time. We think business investment will be higher. And then this one, nobody talks about this. I think this is huge. We ran models, and Congress ran models. They kind of came up with the same answer. We think the lower tax rates are going to help boost labor supply. And in fact, we think probably add about 900,000 workers if the current tax policy is made permanent. So we think we'll add about just under 1 million workers over the next 10 years. And that could mean 20 or 30,000 construction workers for our industry alone. That won't solve the labor shortage, but it's every little bit is going to help. I put this in red. Economists don't like to admit when they get things wrong, but I'm happy to get this one wrong. I thought because of some of the changes that JP described on the mortgage interest deduction and the SALT cap, that we would see a slowdown in home price growth this year. In fact, I cut our national home price growth forecast from about 6 to 7%, which is where it's been the last few years, to half that. I cut it to 3%. Well, the incoming data shows two things. One, I was totally wrong at the start of the year. Home price growth continues to be 6, 7%. There's not enough inventory. The other factor, though, is it is slowing a little bit. Now, I think 3% is probably still going to be too low, but it's going to come down just a little bit than past years. How much of that is tax related and how much of that is due to affordability concerns, the fact that home prices have gone up, despite the fact that incomes haven't grown a whole lot? I think that's an open debate right now. So here's our forecast for the economy. The big question is, when's the next recession coming? Again, we've got 2018, about 3% growth rate. We think tax reform and those tax cuts, JP put numbers to them in terms of some of the business side, that will help create ongoing growth in 2019. It's right here that's the concern. You can kind of see the bar is kind of softening as we go into the forecast window. As I've been telling people, it's kind of hard to forecast a recession. But generally speaking, if you see economists start to put a below 2% growth rate on the forecast table, they're saying there's a high probability of some kind of macroeconomic soft patch, or even 2 to 3/4 type recession. And that's kind of what we're calling for in 2020. It's a slowdown. Now, why is that? Well, one, it's because the current growth cycle is actually 112 months old. I got 111 here. That's the second longest in American economic history. In fact, the only one that's longer, 120 months, the growth cycle in the 1990s. So we're definitely in the back end of a growth cycle right now. But there are some factors that are going to help sustain this, and it will be the longest growth cycle we've had. We're going to beat that 120-month record. One of them is tax reform itself. It's going to increase the size of the economy. And this red line is potential GDP, in other words, hypothetical size of the economy, as measured in June of 2017, before the tax reform bill. The blue line is the size of the economy after the tax reform bill. Now, it doesn't look like that big of a jump, but I kind of measured the difference between those two lines, and they represent about $2 trillion of additional economic income that'll happen because we've got more business investment, more labor supply, taxes are lower, we're going to grow faster. So that's one of the reasons we think, for example, in 2019, we'll continue to see growth. Corporate profits, they should continue to rise, albeit at a slowing rate, again, because that C Corp rate's coming down, so there's a higher rate of return for capital. And then on the individual side, those tax cuts should accelerate wage growth. And in the post-recession period, wages have only been growing 2.1% year over year. We think that's going to accelerate to 2.4% because of tax cuts, and because the labor market's really tight. It means employers are going to have to bid up wages. That'll be good for housing demand. Like I said, the labor market's really tight. The unemployment rate's at 4%. It's this right here that we're a little bit concerned about in terms of a slowing economy, the job openings rate. Those are unfilled jobs. You can see the trend is rising. In fact, we're actually higher than we were during the prior growth period. It's this that's concerning because it means that employers are going to have a harder and harder time filling jobs. And our industry has known that for 2 or 3 years. It's the rest of the economy that's learning it right now. And that could mean we could go from 100 to 200,000 jobs being created a month right now to like 50 or 60,000 jobs being created a month. If you see 3 months of that in a row below 100,000 job creation, it basically means the economy is running out of steam. And it's not a recession like the Great Recession, which was a financial crisis due to a wealth shock for homeowners in the business. It'll just be a slow patch. It'll be kind of a situation where we need to get that labor force participation rate up. Here that is. The labor force participation rate's the share of population that's in the labor force either holding a job or looking for it. And this is the bad news. between 2009 and roughly 2015, it was declining. There's a lot of different reasons for this. Some of it is the opioid crisis, put workers on the sideline. Some of it is, I don't want to be, kind of the sociology of it, but just people who decide I don't want to look for a job, I'd rather stay home and play video games, that kind of situation. But here's the good news, the red line. 25 to 54-year-olds, the last 2 years, the labor force participation rate's been going up. We think tax reform will continue that, and that's really good news because if we're going to continue to create those jobs, that rate has got to get higher and higher in order to grow the labor pool to create those jobs. So this is the job openings rate for just the construction industry. The red line is basically the smooth data. It's pretty noisy. But you can see right now, this is the best measure of the labor shortage in the construction industry on a national basis. Here's the peak rate. This is the percent of unfilled jobs. It was about 2.5% prior to the recession. Here's where we are now. In other words, the labor shortage right now is worse now as a share of the industry than it was prior to the recession. And we had a little bit of slowdown here. You can kind of see it went flat, and then hurricane repair in particular, I mean the Dallas market probably needed an additional 10,000 workers just for remodeling efforts. It's begun to boost it up, and the trend lines continue to point up. So growing our labor force, training the new generation of construction workers is definitely an issue going forward. And I'd like to point out, part of this is not a surprise. Part of it is what I've been calling the Gen X gap, which is that there's simply not enough Gen Xers between all those millennials and all those baby boomers. This blue line is the growth in the labor force that's 55 and older. And you can see from the year 2000, it's up 17 million individuals. So this is the baby boomers getting older. Look at that red line. That's the growth in under 55-year-old workers. It's barely moved in 18 years, despite the fact that that's 2 decades of population growth and immigration. What happened? Why didn't this move at all? Gen X. It's Gen X's fault. There's just not enough of us. And the trend line, the fact that it's going up, is the millennials moving into the labor force. So part of this is demographic. We need to get those millennials into the construction labor force if we're going to grow in the future. The other factor, and again, tax reform is going to help a lot here, labor productivity growth. If wages go up just because businesses are competing against each other, that's inflationary. But if wages are going up because they're more productive, which here's average productivity growth after the recession, here it is now, and in our forecast period, that's good news. And we think tax reform is going to help. And I'd like to point out, basically the construction industry over the last 25 years has seen no growth in worker productivity, but the blue line is overall productivity for the economy as a whole. It's up about 33%. So we've got to increase productivity in the industry. But, like I said, we do expect a soft patch. Part of the reason is that the government deficits are rising. That's going to add 30 basis points to the 10-year Treasury note. So we think interest rates are going to go up. That will have impacts in 19 and 20. Producer prices are going up. Part of that is the lumber story from the start of this year. Typically, producer prices tend to spike right before a recession. You can see right here, part of that is the lumber price increase. Producer prices are increasing. Here we've got the lumber price graph. Everybody in the industry is aware of what happened. Currently, after the last 5 or 6 weeks of decline, those prices are up 30%. I think we can probably thank the advocacy efforts in the industry and Secretary Ross for putting a little bit of pressure on the lumber producers after a run-up that was way in excess of the 20% lumber tariffs. Prices were up 63% at one point, which actually led him to directly say collusion might be going on, a little bit of profit taking. Well, since that was made public, prices have been dropping. In fact, we haven't updated this graph. They've continued to drop, so that's good news. I put in this, I'm going to skip it. Fed funds rate, we think interest rates are going to increase. The red line is the 10-year Treasury rate. We think the Fed's going to increase rates 2 more times this year, 2 more times next year. And what's that going to do? Well, it's going to push up the short-term interest rates, which means the difference between the 10-year Treasury and the Fed funds rate, this is the yield curve, it's going to flatten out. Here's why we think 2020 is going to be weak. When we look at that difference in our forecast period, it gets to 0 right in 2020. And if you look in the past, when this goes to zero, goes negative, a recession tends to follow. So, those combinations of factors, tax reform sustaining growth this year and next, interest rates going up, the economy softening in 2020, that's kind of basically our outlook. And again, interest rates going up, that doesn't mean the 30-year fixed rate mortgage is going to increase, probably pushing above 5% in 2020. So it is going to have an impact on housing demand going forward. And I've got a whole bunch of other slides. I'm probably just going to skip these. But the good news, despite the fact that we've got some macroeconomic weakness in 2020, is the demographics for home building are really, really positive for the next 10 years. And what you can see right now is after 5 or 6 years where all the growth in households was basically among rental households and basically owner-occupied households, homeowners, the count was declining or was flat. In the last 7 quarters, the growth in housing demand has been on the owner-occupied side. Why is that happening? It's because the millennials are moving from their late 20s into their early 30s. And what happens when people do that? They get married, they have kids, they buy single-family housing. So this is kind of behind our forecast, and I'll just kind of end it with this. If you think about a 10 to 15 year look on the future of home building, it's really driven by demographics. And this blue line is a population profile in the United States. Down here we've got age. So for example, this is the number of 80-year-olds that are in the United States. And I divided it into generational boxes. Here's the baby boomers. Here's the Gen X gap. I told you there's not a lot of Gen Xers. And here's why every presentation I talk about millennials way too much. There's just a huge number of them. And they're just entering this yellow box. And this yellow box is your key household housing demand period, renting or home buying. And what you can see is this bulge essentially moves to the right. As they age, the demand for single-family homes is going to grow and grow and grow. And we already have an inventory shortage. And so the good news is with these tax cuts, tax reform, some short-run growth in the economy, and then long-run improvements to the economy through productivity, these people, as they begin to buy single-family homes, we're going to have to build a lot more of them. Probably somewhere between 15 and 20 million single-family homes over the next 2 decades. So I hope you like how we put this information together, kind of trying to blend the tax reform, the efforts that NHB took to kind of defend our interests, promote pro-growth tax policy. It was I think a difficult dance at times, but it was an association-wide effort in terms of members and leadership, the lobbying team, and others. And I want to end with the legal disclaimer JP always puts, which is none of that was official tax advice, so please do not sue us. And I did not put my contact information on the last slide. I skipped it. But with that, I'm happy to take questions on econ, or we can do tax. Justin, yeah. Yeah. So the question is, why, given the fact that we're not building enough single-family homes, home prices continue to rise faster than incomes? We know we have an affordability challenge. What gives? Well, it's a play for hope, which is never a good position to be in, because we don't see in the short run or the medium term those supply-side headwinds that are adding to construction costs easing up. So we know we got regulatory burdens in the sense that a quarter of a new home's final purchase price is due to all those regulatory burdens, impact fees, land use requirements, everything else. We've got a labor shortage, so we know labor costs are going to go up. Land costs are going up. In fact, in the last 3 years on a nationwide basis, land costs have gone up 20%. So we don't see easing on the supply side. So that means the costs are going to go up. The demand is growing. What's going to happen? Well, the play for hope, wage growth. And we're going to have to hope that at some point interest rates slow down, which is why I said only 2 rate hikes this year, 2 more next year. So rates kind of get to a below 6% level. And then the wage growth that we get sustained by tax reform helps reduce some of the affordability challenges. I will say right now the prognostication for the short run does not look particularly healthy. We just released our NHB Wells Fargo Housing Opportunity Index. It's at a 10-year low as of the second quarter. So we've got an affordability challenge. What can we do to do that? Recruit the next generation of construction workers to bring down labor costs. Work with local governments to fight impact fees. Do all those advocacy efforts. And if you're a remodeler, if you're a building material supplier, if you're a realtor, those construction issues are your issues if you complain about the inventory crisis. So we're going to have to manage the supply side, knowing full well that the demand side, we're increasingly going to face challenges. Just in the back of your head, where the don't panic moment is, the demographics are really good. And the concern is that we price out certain households from being able to become homeowners. And so that's a policy issue in terms of being able to build up growth. Phil.
Rob, on the labor shortage, you've got a headcount, obviously, of the workers that are in construction right now. You've got a percentage number of who's missing jobs being filled. Have you or can you go across the country, market by market, state by state, and quantify, recognize how many people are missing in the Dallas area, in Texas, across the country?
So I can give you a national number. The national number right now of unfilled construction sector jobs is 243,000. We track that on a monthly basis. We do it two different ways. They tend to point. We have tried really hard to do that at the state and local level. At the start of this year, for about 6 months, there's another chief economist at BuildZoom named E.C. Roman. He tried to do that at the local level with some data we gave him based on some survey data, some of the BLS data that we use, and we tried to come up with market-to-market definitions, and it fell apart. He used another approach, and there was a story in the Wall Street Journal about a week ago of his approach where basically he went out and got private job opening data, looked at jobs that were open 45 days or longer. Even then, the numbers didn't really, because he had the largest labor shortages in Connecticut, and we know they're in Texas in terms of the intensity. So we're gonna keep on trying. I don't have good numbers for you, but every time I've done it, they don't match up with the national number of 243,000, which I know is correct. Right. So we'll keep working on it. There's no doubt that the labor shortage is a medium-term challenge, and it will impact what kind of housing we build in the future. So, for example, right now, 2% of single-family starts are modular, factory-built. That share is likely to rise to 4 to 6 to 8% over the next 10 years if we have to capture economies of scale because of the ongoing labor shortage. So when we've simulated this, let me put the GDP slide back up here. So we've got softness, and what I've challenged my team to do is that, okay, I realize we've got this 1.5%. Let's just go ahead and we'll simulate a recession. The way we've done it, think of a black swan event like international trade war or terrorist incident, something that really drives U.S. exports way down and causes a recession. Well, when we've done that, what it looks like, about 3/4 of negative growth. The unemployment rate goes from about 4% up to about 6%, which, by the way, is a buying opportunity in our industry. That might be the opportunity to go all in and recruiting those now newly unemployed individuals into the trades. So that could be a 2020 moment if we're thinking about strategic planning, about when to really deploy those resources. But for housing, what does it mean? A little bit of negative growth for home sales and housing starts, but only lasting about 3/4. If you got land, you got to hold it for 4 years. If you got land, you need to get rid of it in 2 years. You might be a little more cautious. If you can hold it for 4 or 5, I think you can probably navigate those waters, because we don't see this anyway as a repeat of this. It's more like this. So a soft recession driven by basically, the fact that rates have gone up, that the economy's having trouble producing those new jobs, and then ultimately demographics, the fact that we've got those millennials coming in larger numbers, helping to push us back to the growth cycle. Yeah. So this gets a little bit harder, but in a hypothetical recession that we've simulated, what does it look like state by state? You're in one of the good places in the country. I mean, it's the southeast, it's the mountain areas, it's the south. that do well. And the reason why is when you look at population growth rates, whether it's Florida, Texas, the Carolinas, Colorado, these are places that are growing in population terms 2 to 3 times the national average. Places that get hurt, I'm sad to say, as a Buckeye, so is JP, it's Big Ten country. It tends to look a little bit worse in the Northeast. And the reason why is those are places where population is already going down. They're moving to places like this. They're aging, which means when they're looking down the road 10 to 15 years and that population shrinks even more and the unemployment rate goes up, not only do they have to pay, like in a state like New York or Pennsylvania, for those retirees who are staying in that state, but now you've got a smaller amount of workers to tax to pay for those pensions. That's a real challenge in a state like Connecticut, New Jersey, Illinois, the states you want to be in, the Southeast, the South, and the mountains. So I'm not saying there won't be, what's that? Low tax states as well, that's right. And I would look at it as how difficult is it to develop land in your state? If it's tough to develop land, then all that growth, like San Francisco or Seattle, that they're claiming home price growth of 10% year over year, that's not being driven by economic fundamentals. It's driven by the fact that there's scarcity in home demand. That is a precarious ledge to be on when an economic earthquake comes along. So easy to develop land, low taxes. Illinois is kind of a good example of what not to do. In fact, when you look at southern Illinois, it's got some of the worst housing markets in the country. And the reason why is who would become a homeowner in a state where they know they're going to have to pay out the pension system over the next 20 years, and there's not enough workers in population to tax to pay those bills. So that's a real challenge for that kind of Big Ten as well as the Northeast parts of the country. Yes, sir.
Compared the U.S. housing with China, the new tariffs, what's the number, one or two things?
So he came up before, JP mentioned him, but we've got an economist on our team named David Logan, who's kind of our tax counsel, trade law guru, number cruncher. And he's gone through all the different tariffs that have been announced in terms of looking at the products. The really large round of tariffs that were proposed against China, the ones that were in excess of $200 billion, he went through all 3,000 items that would have been taxed. What did he learn? About 600 of those items were connected to either home building or building materials and would represent, at a 10% tariff, about $1 billion tax on our industry. Now, what items would those be? Those would be things like tools, steel and aluminum products, columns, kind of raw materials, both in terms of tools and the actual materials that go to build a home. So they initially announced that as a 10% tariff. They're in this kind of tit-for-tat negotiation process where you're trying to intimidate the other side. They've suggested a 25% tariff. 25% tariff would be a $2.5 billion tax increase. So if you think of the triad to get economic growth, it's low taxes, check the box, we got that with tax reform. It's deregulation, check the box, but also work in progress. We've gotten that with Waters of the U.S. and some of the regulatory efforts. Trade policy, that's the one where we're missing. We need to get back to the negotiating table with Canada and work out a new softwood lumber agreement. And we need to stop the trade wars because ultimately, we use the term tariff, but it's a tax. And it's a tax on American homeowners and renters that basically increases costs. And then get to then to Justin's question, what can we do as we know prices are going up? Well, we can get income growth to go up, but we can prevent the growth of construction costs. We can do that at the local level through efficient policy. And we can do that at the national level by promoting pro-growth tax reform as well as fighting tariff raising and trade policy. Any other questions? Yeah.
The question is a comment kind of like
Yeah. So, yeah, I think that's a good point. So the question is basically when you start tallying up all these tariffs, what's the impact on the economics? And I think you can almost say, what was the line that Jerry had that tax reform giveth, or Jerry Howard, NHB CEO, said, tax reform giveth, but trade policy taketh away. If you balance these two things, that's kind of what we're approaching right now, where those tariffs are taking away some of the growth elements that came from tax reform, which is why if these current trade policies are a negotiating position, let's do them, let's move through them quickly and get back to the growth path. If they are permanently intended policies intended to stimulate U.S. production, and this is just me speaking here, count me skeptical. Because the reason why is, and I'll give you an example within the lumber industry. The idea of the lumber tariffs, which is a 20% tariff on Canadian softwood lumber, that's a third of our lumber supply we get from Canada. It's supposed to stimulate U.S. production. But if you look at the sawmill industry in the United States, the employment is flat, 93,000 workers. And it's been flat for the last 3 years, so that hasn't been a significant uptick. Yeah. And so the challenge is, when we've got a labor shortage in every sector, how do you increase the U.S. sawmill industry? Now, we've got some promises that that's coming. I'm a little skeptical about that. And then I'll add in another factor. What do you need to make sawmills? Steel, aluminum, which again, then we're going to put tariffs on. So these things all have very kind of complicated interaction effects. Any other questions? Questions for JP?
Well, I'm Doug Hotchkiss. I'd like to say thank you